There are so many different takes on if or when the housing market will crash, and a lot of these takes are simply based on today's daily tornado of bold headlines. This bit of info ensures a crash, that piece of news means prices will reach all-time highs, and so on and so forth. In times of frenzy and mania, pulling back and taking a more historical approach when looking at today's housing market is particularly important. Granted, many things about today's housing market is different than years or decades previous, which we will get to. Nonetheless, factoring in the past at least gives us a grounded framework to build upon. So with that said, this is the chart I'm highlighting in today's video. The Case-Shiller Home Price Index versus CPI. This chart compares nominal home prices to the CPI or rate of inflation. It doesn't take a complex explanation to see what's going on here. Going all the way back to 1890, we see an incredible matching of the CPI with home prices. This follows pretty much all the way up to the mid-2000s. And today, the divergence of these two metrics is simply incredible. Before getting to what caused this to diverge so heavily, and what the future of this chart could look like, I would just like to point out that should the home price index return to the CPI, we would need to see an approximate 40% decline in housing prices. And yes, it is totally possible that inflation shoots back up, with home prices falling only slightly, so they both meet again. The point of this chart, however, is to show that if we take this historical data, this historic trend and coupling of these metrics, going back to 1890 seriously, then at some point either housing has to drop or inflation has to jump. In other words, this is over 100 years of past data, and using this chart, if we were to make a prediction on it, the obvious prediction would be, based on the decades of data shown here, that at some point in the future, these metrics have to touch one another again. In the 80s and 90s, you can see prices revert to the mean. In 08, again prices revert to the mean. The logical extrapolation is that yet again, prices will mean revert. While it's possible this will never happen, the point being that according to the historic trend, it will. This chart shows that there's a very strong correlation between home prices and the rate of inflation. So one could ask themselves, why should this time be any different? Another way to think about this chart is that essentially from 1890 to 1997, home prices were flat when you adjust for inflation, meaning home prices never really appreciated, they inflated. This occurred because under our historic economy, wages would increase with the rate of inflation. So under what specific factors could these two converge again? Well, to start with, if the CPI is underreported after the Boston Commission changed the mathematical calculation of the CPI index in 1990, then that would instantly raise the CPI or black line closer to housing prices. As I mentioned earlier, should the CPI not change, a 40% drop in home prices would see the two converge again. Take notice of the beginning of the 2000s divergence here. This is when essentially the federal government decided that they would give literally anyone a mortgage. The 08 housing bubble was caused by, among many reasons, high rates of defaults on easy-to-acquire subprime mortgages, which often had no or very low down payments, and many did not require proof of income. To offset the risk lenders were taking on, they used tools such as adjustable rate mortgages, in which the interest rate increased over the life of the loan. There was little government regulation of this market. Ratings agencies were able to make investing in these mortgage-backed securities look attractive and low risk to investors. CDOs increased the demand for mortgage-backed securities, which increased the number of subprime mortgages that lenders were willing and able to sell. Without the demand from CDOs, lenders would not have been able to make so many loans to subprime borrowers. The correction in the US housing market triggered an implosion in the CDO market, which was backed by these subprime mortgages. CDOs became one of the worst performing instruments in the subprime meltdown. These losses resulted in the investment banks either going bankrupt or being bailed out via government intervention. This impacted the housing market, stock market, and other financial institutions.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine.
It's not hard to read hundreds of articles explaining why the market today is different from 08. One similarity, however, is that home prices today, like 08, are in a bubble. A brief summary of these articles looks like this. There is now better verification of income and assets. There's now a record amount of equity in the US housing market due to the considerable home price gains. If a borrower ran into trouble today, there are a lot more options to avoid losses due to the equity in the homes. Fewer loans today have adjustable rate mortgages. There were risky mortgage products with teaser rates. Prior to the great financial crisis, consumers might have bought homes they couldn't afford, and in many cases were leveraged to the hilt. Housing supply is extremely tight, arguably the one factor most dramatically different today from the 2008 era market. It has taken years for home building to get back to pre-Great Recession levels. More recently, however, other factors have come into play, such as the Fed's aggressive interest rate increases since last year has led to much more expensive mortgages. Many sellers are sidelined as well. Anyone who bought or refinanced a home in recent years likely has a mortgage with a significantly lower interest rate, so selling would be a costly proposition. Finally, the average size of a new house has fallen from about 2,350 square feet at the end of 2021 to about 2,200 square feet today. So indeed, this supply criticism of this chart, that if home prices cannot come down because sellers are sidelined as well, would be the typical rebuttal one would see to the proposition that this red line will come down. In another light, when looking at this chart, one should ask themselves, under what extreme conditions could home prices continue to diverge like this from the CPI? So that's all in this video. There are many angles to this that obviously can't be covered in a single video, so let me know your thoughts below. Will we see history repeat itself? Will this chart recouple again in the future? What do you think?